You wake up one morning, check your bank account, and notice something strange. There is more money in there than usual. Not a lot more, but enough to notice. Enough to make you pause before your first cup of coffee. Then it hits you. The car payment. It is gone. You paid off the loan. The final check cleared. And now, every single month, that chunk of money just stays. You feel good about it for exactly 48 hours. Then something quietly, almost imperceptibly, starts to shift. And not in the way you expected. Because here is what nobody tells you about paying off your car. The moment you do it, you do not just eliminate a debt, you step into a completely different financial system, one with different rules, different risks, and a hidden set of decisions that most people are completely unprepared to make. And the way you handle the next 6 months after that final payment, those months right there, will likely determine whether this becomes one of the smartest financial moves of your life, or just a temporary exhale before you slide right back to where you started. Let us talk about what actually just happened. When you were making payments, your financial life had a kind of forced structure. A fixed amount left your account on a fixed date. You budgeted around it, you planned around it. It was an anchor. Irritating, sure, but an anchor. The average car loan payment in the United States right now sits somewhere between $500 and $600 per month. Some are lower. A lot, especially in the last few years, are significantly higher. People who bought trucks and SUVs during the inventory crunch of the early 2020s are carrying payments closer to $700, $800, even $900 a month. That is not a payment. That is a part-time salary disappearing every 30 days. Now imagine that stops. For most households, this is one of the single largest monthly fixed expenses they have, right alongside rent or mortgage and utilities. And the moment it vanishes, something strange happens in human psychology. Financial psychologists call it payment freedom euphoria. It sounds clinical because it is, and it is dangerous. Because the brain does not naturally redirect freed-up money. It absorbs it. Studies on consumer spending behavior consistently show the same pattern. When a recurring debt obligation ends, households do not typically save the difference. They spend it, not on anything dramatic, not on vacations or luxury goods. They spend it on soft categories, dining out a little more, upgrading a subscription, saying yes to things they used to say no to. The money does not disappear in one place. It disappears in 12 places in amounts too small to notice individually, until 3 months later you realize your savings account looks exactly the same as it did before the loan ended. That is the first thing that changes after paying off your car. The war over that freed money begins immediately. And most people lose it without realizing they were ever in a fight. But let us back up and understand the system you were actually inside. When you took out that auto loan, you entered into one of the most quietly punishing financial products in the American consumer market. Auto loans are structured in a way that front-loads the interest. This is called amortization, and it is brilliant if you are the bank. Here is how it works in plain language. In the first months of your loan, the vast majority of your payment goes to interest, not to the actual value of the car. Only a small portion chips away at the principal, the actual amount you owe. As time goes on, that ratio slowly flips. By the end of the loan, most of your payment is going to principal. But by then, you have already paid the bulk of the interest the bank wanted. So if you took a 6-year loan and paid it off right on schedule, you did not just pay for the car. You paid for the car plus a significant premium, all quietly built into the structure of the loan from day one. On a $30,000 vehicle at an average interest rate, you can end up paying $4,000 to $6,000 in interest over the life of the loan, sometimes more. On a $40,000 or $50,000 vehicle at rates that spiked during recent Federal Reserve tightening cycles, that number climbs fast. Some buyers who financed in 2022 and 2023, when rates jumped sharply, paid nearly $10,000 or more in interest on a single vehicle purchase. And the car, the whole time, was losing value. That is the quiet absurdity of auto loans. You are paying an increasing amount of money for an asset that is worth less every single day. The moment you drive a new car off the lot, it loses somewhere between 9 and 11% of its value. By the end of the first year, that depreciation reaches 15 to 25%. A $35,000 vehicle can be worth around $26,000 after 12 months of ownership. You are not just paying for a car, you are paying for the experience of owning a car. That distinction matters. So when you finally pay off the loan, you have survived the amortization trap. You own a fully depreciated, or at least significantly depreciated, asset. And now the question is, what do you do next? Here is where most people make the first critical mistake. They treat the paid-off car as the end of the story. It is not. It is the beginning of a maintenance cycle that demands its own financial discipline. A car that is fully paid off is not a free car. It is a car that now shifts all its ongoing costs onto you without the psychological pressure of a monthly payment to keep you honest. When you have a car payment, you tend to maintain the vehicle. The psychology is simple. You are already paying for it. You might as well protect that investment. But the moment the loan ends, that psychological trigger disappears, and deferred maintenance becomes quietly catastrophic. The average age of vehicles on American roads right now is over 12 years. That is the highest it has ever been. Americans are holding on to cars longer, partly because new vehicles have become extraordinarily expensive, and partly because interest rates made financing brutal over the last few years. A 12-year-old vehicle with deferred maintenance is not an asset. It is a liability wearing a bumper sticker. Tires, brakes, transmission service, coolant flush, timing belt replacement if applicable, battery, wheel bearings. These are not optional. These are the recurring costs of car ownership that your loan payment never covered and your brain tends to forget about when relief sets in. Financial planners typically recommend setting aside somewhere between $50 and $150 per month into a dedicated vehicle maintenance and replacement fund. Not to spend, to hold. So that when the alternator fails at 7 in the morning, you do not have to put it on a credit card at 22% interest. Most people do not do this. Most people absorb the freed-up payment into lifestyle spending and then react to car repairs with debt, which means they did not actually escape the cycle. They just changed the creditor. Now let us talk about credit, because this is where things get genuinely surprising. Paying off your car loan feels like a financial win, and it is. But it often causes a temporary dip in your credit score. Not a collapse, not a disaster, but a measurable, real dip. Here is why. Your credit score is calculated across several categories. One of them is credit mix, meaning the variety of different types of credit accounts you carry. Auto loans are installment accounts. Credit cards are revolving accounts. Mortgages are long-term installment accounts. The scoring models reward diversity. When you close an installment account by paying it off, you reduce that diversity if it was your only installment loan. The model sees you as slightly less complex in your credit profile, and your score adjusts accordingly. Additionally, your credit utilization calculation and the overall age of your accounts can shift in ways that temporarily lower your score, especially if the auto loan was one of your older open accounts. The drop is usually modest, perhaps 5 to 15 points, sometimes more depending on your overall profile, and it typically recovers within a few months. But if you are planning to apply for a mortgage, refinance something, or open any major new credit line in the immediate aftermath of paying off your car, this timing matters. This is one of those moments where the financial system's logic feels almost deliberately contrary. You do the responsible thing, you eliminate debt, and the system briefly penalizes you for it. It is not malicious. It is just how the scoring algorithm was built. But knowing it in advance lets you plan around it rather than be surprised by it. Let us zoom out further, because the real question is not just what happens to your wallet. Paying off your car loan is often the first moment in a working adult's financial life where a meaningful amount of monthly cash flow becomes genuinely discretionary, not earmarked, not already spoken for, just available. And available money is opportunity money. If you know how to see it that way, the most straightforward path is what financial strategists call the phantom payment method. You keep making the same payment you were making to the lender, except now you redirect it somewhere that builds instead of just satisfying an obligation. Into an emergency fund if you do not have 3 to 6 months of expenses set aside. Into a high-yield savings account. Into retirement contributions if you are not yet maxing your employer match. into a brokerage account if your foundational bases are already covered. $500 per month redirected into a retirement account over 30 years, assuming a historically average market return, grows to a number that is genuinely uncomfortable to calculate if you are already behind on retirement savings. Time is the variable that cannot be replaced. But here's the other path, the one the market quietly encourages. A fully paid-off car depreciates further every year. It eventually needs more expensive repairs. And car manufacturers, dealerships, and lenders are very aware that the moment your loan ends, you are the perfect target for a new one. The average new vehicle transaction price in the United States recently crossed $50,000. Let that sit for a moment. $50,000 for a vehicle that will be worth $30,000 in 4 years. The promotional cycles are precisely timed. Dealers know when your loan ends. Manufacturers know your vehicle's age, and the financing offers start appearing. 0% for well-qualified buyers, trade-in bonuses, loyalty discounts. The language is generous. The math rarely is. The average American trades in a paid-off vehicle and re-enters a loan within 12 months of making that final payment. 1 year of freedom, then back into the same structure, usually with a higher principal because vehicle prices have risen. That pattern, paid off, brief freedom, new loan, is the engine that powers the American auto financing industry. It is not a conspiracy. It is just a very well-understood behavioral cycle that the industry has optimized around for decades. And this is where the bigger picture becomes genuinely important to sit with. Transportation is not optional for most Americans. Public infrastructure in the United States was built around the car in ways that make vehicle ownership effectively mandatory in the majority of the country. This is not a lifestyle choice for most people. It is a structural reality, which means the cycle of auto debt is not simply a matter of financial discipline. It is baked into how American life is organized. The average American household spends somewhere around 10 to 15% of its income on transportation. For lower-income households, that percentage is higher, often dramatically so. This makes the paid-off car one of the few moments where someone operating inside this system gets to breathe, gets to accumulate, gets to make choices that are not already made for them by a lender on a fixed schedule. What you do with that window, whether it lasts 1 year or 5, is genuinely consequential. Not in a motivational poster way, in a concrete, numbers-on-paper way. So here is where we land. You paid off the car, the payment stopped, the money showed up, and now you are inside a moment that most people experience without recognizing it for what it is. It is not a finish line. It is a fork. One path is comfortable and familiar. You absorb the money into lifestyle spending, defer the maintenance, ignore the credit score blip, and within a year or two, you are sitting across from a dealership finance manager signing a new loan. The other path is quieter, less exciting. It involves treating that freed-up payment like it still belongs somewhere important, even though no one is demanding it anymore. It involves building a cushion around the car you already own. And it involves resisting, very deliberately, the extremely sophisticated and well-funded system that would prefer you stay in perpetual monthly payments for the rest of your driving life. Neither path is irrational. One of them just costs significantly more over time. Here is the question worth sitting with. When money is no longer being extracted from you on a schedule, do you extract it from yourself with intention? Or does it just disappear into the comfortable noise of everyday life? Most people never find out the answer, because they never really stop to ask. If this made you think differently about something you thought you already understood, that is the whole point. Hit like if you want the algorithm to show this to someone who needs to hear it. Share it with a person in your life who just made their last car payment and has no idea what comes next. Drop a comment below with what you are actually doing with the money now that the payment is gone. Honest answers only. And subscribe if you want to keep seeing financial systems explain the way they actually work, not the way they are marketed to you.